How many times you've been told that you must start investing in the stock market right now because the market is too hot, or that you should wait because it is too risky? Feeling confused? In this video, we're going to put things in order and give you some examples with real numbers that will help you understand when is the right time to start investing. Hi guys, welcome to Take It Finance. We are value investors that see long-term investing in quality companies as our methodology. It is important to note that we are not financial advisors. Our content represents our opinion and it is meant for entertainment purpose only.
We have noticed that many investors don't know when is the right time to start investing in the stock market. We have created this video to make it as simple as possible and give you the essential knowledge so you can start your own investment journey. Let's dive in. Meet the three siblings, 20 years old Nora, 30 years old Johnny, and 40 years old James. Nora invested every month $1,000 for 30 years. She will stop investing when she is 50. Johnny invested every month $1,000 for 30 years. He will stop investing when he is 60. James also invested every month $1,000 for 30 years. He will stop investing when he is 70. That makes $12,000 a year and $360,000 over 30 years for every sibling. All of them received a 3% interest rate on their invested money. How much money will they have at the age of 70? We use the following formula to calculate the future value of their investment. Nora will have a little over $1 million. Johnny will have $780,000. And James will have $580,000. As you can see, Nora has doubled the money compared to James, even though they invested the same amount of money for the same number of years, during the same market conditions. How does it make sense? That's because Nora started investing 20 years before James. The additional 20 years were valuable years for Nora, since her money was accumulating. Now, let's take the same amount of money and see what happens if they receive 6% interest rate instead of 3. Nora will have a little over $3 million, which is 3 times the initial interest rate. Johnny will have $1,700,000 and James will have $960,000. What are the main takeaways from this example? As you can see, 20 years of compound growth can make a significant difference when it comes to money accumulation. A higher interest rate changes dramatically your rate of return, which leads us to the next point. The stock market is a great place to get high returns with a reasonable risk rate, as long as you understand what you are doing and do not speculate. In future videos, we are going to show you how to evaluate companies by yourself so you can invest your money wisely. Subscribe to our channel to join our journey.
Now let's get to the point. Should you start investing in the stock market right now or wait for a market correction? On the one hand, there are always potential crises awaiting behind the corner, and there are many reasons to avoid the stock market at any given point. As you can see, in less than 10 years, from 2009 to 2020, you could have found many reasons to avoid the stock market, such as the US election, the trade war, Brexit, and even COVID-19, not to mention your personal reasons. That means that you don't have to look for any particular excuse to avoid the stock market. Local and global situations will always provide you with an excuse to avoid the stock market. On the other hand, disasters are unpredictable. We keep hearing hypothetical prophecies, but eventually the majority turn out to be false alarms. No matter how bad the situation might seem, history shows that the global market, and the US market especially, tend to grow in the long run. We can't live in the present and constantly fear future events that didn't even happen. Living life this way can prevent you from doing even daily things, such as going to work or shopping for groceries. On your way, you might be involved in a car crash, get robbed, or even sleep on the stairs. But you keep doing these things, right? Because it is worth the reward. The same applies in the stock market. If you want to be at least financially comfortable, you need to take some risk. You should reflect it and understand how much risk you're willing to tolerate. Remember, the higher the reward, the greater the risk you take.
What about inflation?
That's a good question. Prices of goods and services such as utility bill and groceries always change. Prices rise and fall, and here comes inflation. Inflation happens when there is a large increase in many goods and services and not just individual ones. It basically means that you can buy less for $1 today than you could yesterday. In other words, inflation reduces the value of money over time. As Henny Youngman said, Americans are getting stronger. 20 years ago, you needed 2 people to carry $10 worth of groceries. Today, a 5-year-old can do it. These days, the inflation rate in the United States increased to 9.1% as of June 2022. This is the highest inflation rate since 1981, meaning that if you're not investing your money, you're losing every year a relative portion of its value. Let's say that in May 2020, when inflation rate was merely 0.1%, you had $10,000 in cash sitting in your bank account. And that's exactly the amount you needed for your dream vacation that you've been saving for some time. Due to COVID restrictions, you couldn't book your trip that year, and you had to postpone it until May 2022. But guess what? The trip that costed you $10,000 2 years ago costs now $10,850. Think about it. How insane it is that your buying power and money are fading away. Whereas, if you would invested your money in the stock market, your average rate of return was 10.5% before tax. Inflation is a war we should fight. And what's better winning with no casualties? Bull markets tend to last 3 times longer than bear markets. During bull times, the market is optimistic and therefore goes up, while during bear times, the market is pessimistic and therefore goes down. Yes, we've been there too, watching our investment losing 25 and even 50% of its value. It's not pleasant. But even then, if you've chosen a good company with strong management and you've done your research, you should remind yourself that there are more upsides than downsides, and that in the long run, the market tends to go up. As the great investor Peter Lynch said, most people lose money waiting for corrections or anticipating corrections than the actual corrections. At the end, time in the market and not timing the market is what makes the difference.
Wait a second. Before clicking the buy order, you should ask yourself when will you need the money? If the answer is between 1 to 3 years, you should consider your investments carefully, because in short periods of time the market tends to be very volatile and very dangerous, so you can lose a lot of money and have a major heartbreak. If you're willing to invest your money for a period of 10 years or ideally even longer, don't wait for a market crash. As Warren Buffett likes to say, our favorite holding period is forever.
In this video, we have covered various reasons why you shouldn't wait for a market correction and start investing right now with every sum you have. We keep using these guidelines whenever we face an optimistic or a pessimistic market.
If you have found this video valuable and you want to learn more about the stock market, please hit the subscribe button down below and follow us for upcoming videos. We believe that our upcoming videos will help you in your investment journey. Let us know what you thought about this video by clicking the like or dislike button and leaving a comment down below so we can improve our content and keep creating more great videos for you.